Hi, family and friends. It's TRUEsday Tuesday. Today, I'm going to be talking to you guys about life insurance as an asset, not as an expense. So, one thing that I keep coming across and noticing that whenever we're sitting down and putting a plan together for your financial future, and especially for retirement, when you're focusing on building retirement and just really setting your family up so that they're going to have generational wealth and providing with the generational knowledge, a lot of people do not understand life insurance as an asset and not as expense. Um, Life insurance is often viewed as a necessary expense just to help protect the family's future in case of death, right? And it's really, really more than that. So I wanted to just break down with you guys some of the ways and the structure, how things are set up and the beliefs, and just kind of help you move past that so you can build a strong foundation for your future. Because reality, life insurance is can be a valuable asset in your overall financial strategy, and it's going to offer more than just death benefit protection. Okay. So this is how it's often listed whenever I ask someone to list their assets. Many people are including their stocks, bonds, savings accounts, home equity, retirement, and asset, and cars as an asset. So they clearly understand, everyone clearly understands these are all assets. Some of them may be a little bit have more liquidity than others, but they all consider assets, right? And then with the expenses, they list the mortgage, utilities, food, clothes, kids' education, auto insurance, disability insurance, health insurance, and then at the very bottom, life insurance, because what are they doing? They're looking and seeing this as a necessary expense to protect in case something happens. When in reality, life insurance should be on the opposite side. It is definitely an asset, can be an asset, and that does depend on what type of life insurance you have. But you can definitely set it up so that it is an asset and not just an expense. So there are four tax advantages that not I can't really think of any other tool as far as retirement and building that can be used that's going to have four different tax advantages. So the tax-free death benefit, one. Two, the tax deferred accumulation potential. Three, the tax-free distributions. And four, the tax-free accelerated death benefits. So let's go back to one. So this is generally the beneficiaries of the individually owned life insurance policies do not have to pay income tax on the death benefit, thanks to IRC Section 101A. A lot of people don't know about that. So it's true whether they take the death benefit as a lump sum or over a period of time. However, if the death benefit is taken over a period of time, any interest earned would be taxable as income to the beneficiary. So life insurance proceeds may be subject to estate taxes. With the tax deferred accumulation potential, any cash value growing within a life insurance policy is tax deferred. The owner of the policy is not required to pay any income tax on the cash accumulation while inside the policy. So think about that. So you're just getting that growth that's continue to grow within a life insurance policy. Tax deferred accumulation. Number three, tax-free distributions. So loans are taken against the life insurance policy cash value, and they are not subject to any income tax provided the policy is not a modified endowment contract. And I'll go over that with you a little bit more in the end. So definitely, if you're taking out the loan against that's how you're, using the cash value without having to worry about those, taxes on that distribution. So number four, the tax-free accelerated death benefits. So if the insured becomes terminally or chronically ill, a portion of the death benefit may be paid out while the insured is still living. So this is not just only if you die. These are things that you can take in and use while you're still living. So these tax-free Living benefits are paid on a per diem or other period basis and are excluded from income tax up to the limit determined by the IRS per IRS section 7702B. So you definitely want to make sure if this, becomes a situation that you reach back out with your advisor, the person that helped you, so you can take advantage of these, offer these tax advantages within life insurance, right? So this is the so you can have a MEC policy and you can have a non-MEC policy. So there's different types of life insurance. Definitely want to make sure that your policy is set up so it's a non-MEC policy. With a non-MEC policy, the death benefit is income tax free, as well as the MEC policy. With the cash value accumulation with a non-MEC policy, it is income tax deferred. Now, if your policy is set up and is becomes a MEC policy, income tax deferred until distribution. So you want to keep that in mind. And then for a policy loans with the non-MEC policy, it's going to be an income tax free. So you don't have to worry about the income tax to these policy loans. If a policy is a MEC, considered a MEC policy, any gain on the policy is taxable and must be withdrawn first. So plus you're going to have to pay a 10% federal additional tax if prior to age 59 and a half. So that's something you want to make sure and just get clarification as far as when this account is set up. You don't have to worry about it. You're going to receive the death benefit, cash value accumulation, and be able to do also the income tax-free policy loans. And then last but not least, when you get ready to access that money in the form of policy withdrawals, a non-MEC policy is income tax-free up to the cost basis. So that's going to be premiums paid less any withdrawals. And if it's a MEC policy, any gain on a policy is taxable and must be withdrawn first. So it's going to apply the same way as a policy loan. So what I want you to do is just take a new look at life insurance as an asset in your overall retirement strategy. Things that you want to consider are going to be the cost of life insurance policy, including premiums, any cost of insurance charges, is dependent on your age and health and time of the application. So it's going to make a difference. Say, if you say, well, what happens if I wait? Well, if you wait, you're going to be older, and we never know if you're healthy now, if any health conditions may come in the future. So that will affect, your application. And then most life insurance policies require health, in some cases, financial underwriting. There are policies that are no medical, like they may it depends on what type of policy you're going to go towards. But if you're looking for the 4 tax advantages, it's going to have the health, underwriting. So you're going to have to keep that in mind. The life insurance involves fees and charges, and it also includes the surrender charges, which may reduce your principal. But that's pretty much all that I have to go over with you guys today. With our main goal is just really to look at life insurance as an asset and not an expense, and take advantage of that and use it to set up your retirement, use it to set up your future for your family, so you can take advantage of these tax advantages that you should be using, which a lot of us are not. That's all I have for you guys today. Thank you so much for joining me. I'll see you guys next Tuesday. Have a great week.